changes that we can expect. If you are a business owner, this is extremely important. And trust me, there's going to be so much information that you're going to get tonight. You guys can go to our REIA Radio YouTube channel, and every event, including this one tonight, is on there. So if you don't get good notes tonight, go to that. You can rewatch it. And so REIA Radio YouTube, and check it out. Real quick, I do want to introduce some of our sponsors, and I'm going to start with Coley Jessen. We have many sponsors been with us since the beginning, but Matt Spiker Coley's been with us the whole time, plus my personal attorney since 2018-ish. And I want to introduce Matt with Coley Jessen.
Thanks, Ted. Hi, Matt Spiker here. I got Jeremiah Perkins and Minya Heron as well. Jeremiah's in a real estate group, so if you have an opportunity that you need some oversight on, he can help you. And if you have something that goes bad, Minya's in our litigation group, and she can help you too. In any event, we're a full-service law firm. I've worked with a lot of folks from this group. If you have a question, something simple, give me a call. I'm not going to charge you. I love talking about ideas. I love the energy, the entrepreneurial spirit of this group. It's just great to be a part of it. Thanks, Ted, for letting us be a part of this and be a sponsor.
Thank you. A round of applause over here for Matt. And tonight's drink sponsor is Angela. And Angela's with Set Stage. Second time you've been our drink sponsor this year, so thank you so much for that. And if you guys are new and don't understand what the drink sponsorship is, after the event is where we like to have a lot of fun. And we find that the best networking always happens after the event. And so there's a bar right down the hallway. And Angela and her company, they're taking care of the first round of drinks. They are beers, just so you know. So if you order a cocktail, it's going to go on your tab. And because there will be no drinks for everybody else otherwise. But Angela, can you tell us a bit about your company, what you do? And thank you, by the way. You staged a house for us. And that house went under contract in 2 days. Is that right, Hal? Yes. Yeah, 48 hours. And so and you guys are a little unique. So tell us what you do.
Hi, good evening, everybody. Angela Markham with Set the Stage. We not only help realtors market their homes through home staging, but we also sell all of our furniture. So think walking through our homes and shopping the staged furniture and decor that you see in front of you. So everything is for sale. And when you look at our staging samples, you're not going to find anything that's used. The prices reflect the amount of times the staging furniture has been moved. So no drink rings on your tables. We like to say no booty prints on the couch because nobody wants a couch with an indent in it. So everything is in really good condition, but at a really, really great price. We also furnish we can help furnish investment properties with new furniture as well. So if a homeowner is looking for a furniture refresh, or you're looking to just buy a set of furniture for maybe a model home, we can help with that as well. So that's what we do. Oh, yep, the investment properties. So we can Did I turn it off? Okay. We can fully furnish investment properties. We can help stage them if you're just looking to rent the furniture, but we can also furnish properties, come in, do the install, everything from linens to stocking the cabinet drawers in the kitchen. Whatever capacity you need us, we can help with the investment property furnishings as well.
And thanks for taking over our drinks. Appreciate that. Dave also, same time you guys, Coley, Frankel, Blackstone Insurance came on, you guys were there too, yeah. And so you've been with us since 2020 when I took over the REIA. And Midwest Title is the largest title company. Can I say that? Independently owned in Nebraska. Great group. I've been working with them for years. I was introduced to you by the Schlickburns. And can you tell us a little bit about you guys, what makes you unique? And the cool part is, you know, the thing that you do with coming anywhere to do a close. And I think that's handy.
David Welty, Midwest Title Company. I've known Ted a lot of years now. Always appreciative of the group, just like Matt said. There's so much brainstorming and deals to get done here. It's pretty impressive what the group's grown into. But like what Ted was saying, I've been in the business for 24 years. We were built by investors. You know, in fact, this weekend, one of my longtime customers trying to put a deal together, calling me on Saturday, ran the title search for him, broke it all down. He was able to get the deal locked in, gave him a heads up that they need to determine inheritance tax on it. Already had that done. He's going to close on a deal here on Friday. So quick close. I'm always available. But at the end of the day, we built our company on going to the most convenient place to get the deal done, wherever the buyer requests, seller requests. We travel to closings, make it easy to get the deal done. We are full service. So since we're on the topic of taxes tonight, we do provide 1031 exchange services, and again, full title and escrow closings. But I've been around the block 24 years, seen a lot of things. Feel free to give me a buzz, run scenarios by me. More than likely solve the problem that you're going to run across than buying some of these distressed or flip homes and whatnot. But David Welty, Midwest Title Company, appreciate all you.
Appreciate what you do. Got Ram over here. He's with JM Real Estate Capital. Him and Rob have been a member group at least since 2022, maybe 2021, and providing all different types of investments. It can be from getting into the business side business investments, but you guys do every type of loan, right? Can you tell us a little bit about the idea? Because if you just say, hey, I just do hard money or I just do traditional loans, I don't think it really gives an idea of everything you guys offer.
That's right. So JM Real Estate actually does your fix and flips, DSCR, ground up construction, business lines of credit. I actually do a lot more than that too. So if you have commercial or residential, whatever it is, we have 5-day HELOCs. We have a lot of different type of HE loans we can do. My goal or my job is to basically help new investors, regular investors, get the financing that they need. So whatever that you need, just let me know and I'm here to help you. Another thing is we do have a raffle for the books going on. There are cards in front of you with some pens maybe. Please fill it out. We've got 2 different books here. Ted's going to fill you up on that. But other than that, if you have any questions, let me know.
Awesome. Thank you. Appreciate it. Yeah, so we got Strength. They provided Rich Dad, Poor Dad. And then what we always say is we give away books. If you guys love the book you read and you want to donate it back, you can put your business card inside or donate it back and we'll give you a shout out. So shout out to Austin Compton for bringing a book back. And so if you do bring it back, put your card in, we'll shout you out in your business. And it's kind of like a recycle program. You know how like sometimes you go to those houses and they got the book right in front of the books right there. It's kind of like that, but we're gonna give you a shout out to your business. We want to have one time we had like 15 books here to give away, which was really cool. So if you want to donate a book, we'll shout out your business on there. But if you want to bring one back, we'd love that too. So over here we got Jacob Frankel, been using your guys' service also since 2018. Great firm. Now they have a sign on the Dodge Expressway that you can actually see where you're at. You might want to come a little bit closer over here just because the reception of this is all the way in the corner. You tell us a little bit about you guys, what you offer, and obviously one of the partners is speaking tonight, so we'll learn a lot more about you.
Absolutely, that's right. Yeah, I got the big boss here watching. I'm Jacob, and then Scott's with our accounting services department. So we're full service. We do taxes, payroll, sales tax. We even have a tech services department just because we had enough clients who needed help with their websites and things that we built that out. So really anything you have questions on, come on up and ask us. We also offer, Jordan, an hour free consultation to REIA members, right? So yeah, once a year we'll do that. If you're trying to do it once a week, we'll have to cut you off. But yeah, come bother us if you got any questions. Thanks.
Thank you. Can we break those apart to like little phone calls? Like, hey, I got a 15-minute question, and then I got another 15-minute question. Matt's like, I don't make that offer. Hey, a couple other details real quick I do want to cover before we wrap up. It is one of my goals every year is to be able to present to you guys a full lineup for events coming up. And I've been working really hard to try to get the events lined up. If you saw the flyers out there in the hallway, they are kind of giving you an idea of what's going on. But I do want to give you guys some clues of things that we have coming up here. So in January 6th, I always try to keep the first Tuesdays, but just, if it's like a holiday or there's something on it, like I had to move July date because it's my wife and I's anniversary. And Jessica she's at the front there, she would kill me if I would have done it that night. So it's a Thursday that time. But January 6th, we do have Jeff Beals from Grow Omaha Radio Show. If you want to know about what's happening in Omaha development, this is a great one. I always mention it. There's things that I find out from Jeff that are up and coming that I don't know that are happening, and it's good to know where to invest because there's development happening. Jeff has got one of the top radio shows in the state of Nebraska, and a great guy to know. Grew up as a neighbor, and he helps us out. Definitely don't miss that. January 16th, we have a REIA Mastery Series. You would see these flyers on your table. And if you guys are, it's a full day conference that we're holding. We have Casey Gregerson coming in from Houston. He's flipping about 70 to 100 houses a year. We have Megan Ahern coming out of Lincoln. She runs a company called First Deal for Brandon Turner, and she is flipping with her husband around 40 houses a year. We have Michael McDonald. If you've ever seen the rocket or launch home buyers? You've seen those commercials. He's out of Las Vegas. He's originally from Nebraska. He's got marketing campaign going on nationwide. I don't know how many deals he's buying, but he's buying a shit ton. And he's really killing it. It'd be a great guy. We're flying him in. We have Clinton Bartlett. He's a full-time flipper. He holds a couple hundred rental units here in town. And he had a podcast called Failing Forward. So he's going to talk about the fails and mistakes that he made about going forward, because that's where we learn. And then we're going to wrap it up with Tucker Pinion. Tucker started off as a maintenance guy at Orange Property Management. And 2 years ago, in 2 years, at least when we had him on the podcast, he's probably got way more now. He's got 140 rental units. And he's doing a lot of it with through the Pace Morby. What's that called? Subject to, thank you. He's doing a lot of that through Subject to financing. He started a dumpster company. Remember when we were interviewing him, he's talking about how he had to create a deal. I think it was in Columbus, where he bought a package of, I don't even remember what it was, 20 units. And he's like, yeah, so I got them to sell me this first quadplex, and they did it like half price. So then I could get a higher loan on that and then put the cash on the other loans to get it done. So like this guy, he's amazing. He's young. He's only 24 years old, and he's kicking ass. And I think you guys will really love what he's doing. But we have a great lineup. And if you guys have not been to one of our mastery events, doors open. It's here in this room between 8 and 9. We have coffee and donuts in the lobby. We will have, each speaker has an hour and 15 minutes. There's no breakout sessions. It's all right here. And so we'll have 3 speakers. And then we're going to have lunch. We have a catered company coming in. They're going to do a taco and nacho bar for everybody. It's all included. And then the next 2 speakers will come, and then we have a happy hour event that's going to be in bar. All that's included. If you remember, it's only $250. And we are trying to get everything locked up through Randall School Real Estate. If you are a realtor, to try to get that 6 credit hours. We were able to do it last year. It's all about getting the forms in on time, and my deadline's December 5th, so I'm trying to get everybody to do that. And I will let you guys know about credits. But last year we did sell over 125 tickets. The room holds 125. So if you guys are interested in that, or if you're interested in sponsoring that event, please let us know. All the details are on the table there for you. Also coming up in February, we have Chris Pomlu. Chris is going to be talking about structuring and funding deals. We have Andrew Devlin on March 3rd. Andrew comes from the UK. He was one of Tony Robbins' top coaches for over a decade. He was business partners with Jason Dries, and we have him on our podcast. Absolute badass. And if you want to get pumped up and just really learn, I don't really bring a lot of these coaches in, but this guy, like, I was doing his group sessions with my Jason Dries coaching, and I was inspired every single time I listened to this guy, and I think that you're really going to love him. And then listen to the podcast if you want to learn more about him. And then I was in New Orleans at a conference recently. I met a guy named Jason Wojo. We did a podcast with him a couple months ago, and he has a company called Life and Air. It's about how to design your business and life that you want. He's going to be talking April 7th. We have 3 other national speakers. We're waiting to confirm on dates. That's why I haven't given you all the dates, but you're going to love some of them that we have. Trust me. And I'm super excited about that. You guys like these names that we're dropping so far? Okay, good. I've been working my ass off for this. Fun announcement. We, starting in January, the luncheons are going to be for members only. We're starting to get to a point of capacity that the lunches are getting a little crazy. The next lunch we're going to throw a reservation up for it because I know it's going to sell out. We have partnered with Colin Schwartz and the Titan group that he has. And this will be a special Zoom meeting with his club members, and we're going to broadcast it into the lunch event with Brandon Turner. And it's going to be all about goal building with Brandon Turner for our REIA luncheon on the third Friday. So keep that in mind. Updates. I told you guys to tease this a little bit. I'm sorry, I'm keeping you here. I had a lot to cover today. I'm sorry. But hey, the most we've ever done in an increment of price hikes on the REIA membership has only been $25. We are gonna, I don't know what the amount is fully. We're figuring out the numbers yet, but there will be a price hike. I know you guys are like, what the hell? We did not raise the prices last year. Full honesty, my wife and I have never taken a paycheck from this group. I do this all volunteer, and I put a lot of hours into this. So we are going to raise the prices a little bit. My goal is to make a little money, and then that way my accountant Jordan here can look at me and be like, dude, what are you doing with this REIA group? If you just so you guys know, if you just signed up for a membership today or whenever, your membership's still good for the 12 month. It doesn't matter. If you early renew your membership before the first year, you can still honor your prices and it'll tag on. Just so you guys know, I'm not trying to get anybody, but I got to make some changes in this, and I need to make this business profitable. And in exchange, we're going to have some new stuff coming out. We're going to be launching some mastermind circles. So if you feel like there's a mastermind circle that you'd want to manage, there's going to be some benefits like a free membership and other things to you. We're going to have more details coming online about this, except not on Facebook because I'm banned from groups for 6 months. But my assistant will send it over across. The luncheons will be members only. We're going to do a monthly Zoom event. I'm going to announce some dates on that. Jason Dries will be running the first Zoom event on our group calls. And then there'll be rerun available, but these will be Zoom conversations, hot seats, topic conversations. We're bringing people that we know that we met through the podcast, influencers, people that we normally can't get to speak in front of you. The large discounts with the mastery events. If you're a member, it's $250. Otherwise, it's $350. So that's $100 off right there. And those will continue and probably increase. And we are working on some tech tools that are going to come out. I can't get much more detail on that, but we have a January launch date of some new tech tools that are going to benefit you guys. And I'm excited about this. It's going to bring a lot of benefit to you guys and our sponsors. And more details will be coming in January about that, but this will all benefit our members. And so, yeah, so there'll be a lot coming. I want to make sure that if I do something, I do it right. And I want to make sure it benefits you guys and helps you guys grow in your business. Most I've ever talked ever. So Jordan, I'm helping you so you don't have to talk as much. Last couple things here. We have a podcast called REIA Radio. If you guys haven't checked it out, Owen Dasher in the back there is my business partner. He is the voice behind it. I'm the guy that works in the background. He's the guy that talks on the podcast. We just got done with doing a rerun of Casey Gregerson, and we have tomorrow we have Tom. Oh my gosh, Matt Tompkins. Thank you. I said Tom. Matt Tompkins. He owns a company called Entrepreneur Addict, and he is a marketing guru. I used to do some radio shows, and he was one of them. He had Matt and Ben on Twister 93.3. I used to do a show with him back in the day, and he has a big marketing company. We were trying to get some more topical conversations on those podcasts. And we talk specifically about how to market your business and different tactics. So if you jump on the podcast tomorrow, it's going to be a little different. We'd love your feedback. If you like the topics, we're going to do a little more often. So check out REIA Radio. Give us a 5-star review, please. It really helps. And also, sponsors, thank you guys for coming. Really appreciate you guys. I do want to let you guys know that UMB Bank just renewed as a silver sponsor. So thank you to Brady over there at UMB Bank for renewing with us. We really appreciate it. And I am talking so much, I'm just going to go ahead and wrap this up. I do want to introduce to you Jordan Downey. Jordan is a CPA and partner with Frankel, not Zachariah. And Jordan's specialty is working with LLCs in different states. He is also a real estate investor. And we had him on the podcast. I'm going to say it. You didn't want to talk a lot about your real estate investing, but I don't know about you guys, but when I work with my accountant, which happens to be Jordan, I want to work with somebody that does real estate investing. And because I figure you're going to know your shit if you actually are in it, right? Yeah. So Jordan is a seasoned professional. You've been with Frankel for how long?
16 years.
16 years, yeah. And so, yeah, if you want to go to the right person, get it done right the first time, and have an amazing accountant, Jordan's definitely a guy. He gets it done, and he can do every aspect of it from the 1031 on. So, without further ado, I'll introduce Jordan Downey.
Thank you, Ted. Appreciate it. All right. Hey, honestly, very grateful to be here. Thank you for having me. I think I've been out here for, gosh, this has to be like the 10th year, I would say, that I've presented for Omaha REIA. Before Ted was involved, when we were in a small auditorium in the middle school. So that was fun, it was a good experience. I can assure you I am more polished now than I was back then. So we'll try to make this engaging, informative, and mostly applicable to what you guys are experiencing and doing and what you can expect, particularly in the tax laws, things that you can plan for, and really just, I kind of need a little bit of help here from the audience, because I can sit up here and just draw on and keep talking and talk in a very monotone voice, and we'll just keep going, and no one's going to like that. So raise hands, step up to the mic, ask some questions. I think it'll benefit, you, it'll benefit your neighbors, and hopefully we can kind of get through this and have some fun as well, and you can take a few points home in the meantime. We kind of introduced our firm already. I am a partner at Frankel. I've been there for 16 years. I've been investing in real estate for somewhere around 13 years. And so it's something I believe in. I also am excited. The tax law, the changes, the economy, the things that are happening now, it seems like there's starting to be a turn to the better as the market kind of gets, reset in a way. And so I'm seeing more deals. I'm seeing clients are finding deals. And so that's exciting, my mind. So I hope you guys are experiencing the same thing as well. So without further ado, this last year when I was here, we talked about some of the changes that were going to happen. And really the changes that were going to happen were going to basically revert back to where we were previous to the TCJA, the Tax Cuts and Jobs Act, back in 2017. We were going on a cliff. Things had already changed essentially for 2025, but in July timeframe, that's when the OB3 came out, the One Big Beautiful Bill Act. And so in that act, there were certainly a lot of changes. There was a lot of things made permanent as well. Some of them good, some of them not so good. Just kind of depends on your situation, where you're at in your investing, and your personal tax situation. But for the most part, what it did was provide a little bit of stability in what everybody can expect. And so basically, most of the things, some of them were made permanent, but some of them were just pushed out to 2030. But even with that, we've got 5 years of stability, so we know what to expect, and we can use those tax laws to plan, and we don't have to worry about it changing in the middle. And when I say permanent, Congress made it permanent, but they can also undo it. So it's only permanent as long as the administration decides it's permanent, right? Okay, so One Big Beautiful Bill Act and real estate. Okay, so when we are going through this, there are a number of changes that we're not going to talk about. Some things like you hear in the news, and some of the highlights are no tax on overtime, which has its own nuances, and the tips, no tax on tips. I don't really bring those into this presentation, so you'd have to go sit through a different presentation for some of those things. I wanted this to be relevant to real estate and the investors. And so that's what this is geared towards. So hopefully we hit on those things. But if I'm not talking about something, it doesn't mean that I'm not versed in it. Just I didn't think it was applicable. But if you think something's applicable to you and you want to ask about it, then certainly bring it up. Okay, so here's kind of a little bit of an outline of what we're going to talk about today. The SALT cap, this is really just on your personal side, but it's something that is related to real estate, and the income taxes in Nebraska is a higher income tax and real estate state, and so it would apply. Previously, all of the deductions, this is if you are itemizing, you are limited to $10,000, whether it's all the state and local stuff. So mainly for Nebraska, it's real estate taxes. It could be sales taxes, depending, and then income taxes as well. And so this will give, it changes the limit from 10,000 to 40,000, and this is effective for the next 5 years. But it will give some individuals the ability to go ahead and take advantage of the state income tax and real estate taxes that we're paying in Nebraska. Now, the other thing that was made permanent in this that kind of diminishes the value here is that the standard deduction has increased quite a bit. So for married filing joint, it's about 30 grand. And so you'd have to have, real estate taxes, state income taxes, and potentially like home mortgage and donations that will go above 30 grand before this even becomes applicable to you. And don't be confused, this is really just for personal deductions. So any sort of business deduction is going to go somewhere else on your return, and there's no limitation on that in that sense, okay? How do we get around that? Part of the law that came in years ago has this workaround now. So the limitation of 10 grand, now there's a workaround with the states where they allow you to elect, if you are a pass-through entity, to pay the tax at the entity level. And so you don't have to worry about the limitation at the individual level. You get the business deduction, and you don't, and yeah, again, you don't have to worry about it, and you can take the standard deduction and likely be able to take more of a deduction when you net everything together. But that's a workaround. It's a planning opportunity, particularly for Nebraska. So Nebraska, back in maybe 2 years ago, they said, okay, we're behind the 8 ball. We need to go ahead and allow our residents to do this because the rest of the country is doing it, so we're a late adapter. And so you get to go back from 2018 to 2022. So you have those 5 years. And if you were filing an S Corp or a partnership and you had income in those years, then you have to go back, elect, and pay that tax through the entity level, and you get the whole deduction now. That election, we literally have, 25 days left into the year, and so you have to have that done before the end of the year or you lose that. This has been around for the last 2 years, so if this is the first time you're hearing about it, then you should probably come and speak to me or one of our talented staff who can kind of walk you through the process. But it's a timing aspect, something that has to be done before year end or you lose the benefit. And to just give you like a little bit of an illustration, if you're paying if you had $100,000 of income for those last 5 years, and the state income tax rate is 5%, so we have 25 grand worth of tax. That could equate to a benefit of somewhere around on the federal side, I don't know, maybe 10 or 15 grand worth of benefit there. But it's all timing. It's when you make the payment, you got to make the election. Nebraska obviously has some stupid process, so you got to follow that. And so if you need some more advice on that, we'll be around later, but we'll move on. Interest deduction, this is just a permanent thing. They just capped it at $750. If you take on debt, it's all acquisition debt. You can use it, so you can have two loans, primary, secondary. But if that secondary loan was not used for to purchase the property or to do a substantial improvement, then the interest on that's not going to be deductible. So, but if you're using like your home as equity to fund your other real estate ventures, well, interest tax, and so it would follow where that investment went. So the expense would go to the real estate side, and so it's not limited there because it'll go over to the business side. You just have to track it and make sure you tell your accountant what happened and where you finance deals and stuff like that. Here's the biggest thing for this group that came out of the OB3. Bonus depreciation on assets that have a class life of less than 20 years. So think carpet and appliances, exterior improvements, concrete, all that stuff, particularly on like the residential side, but qualified improvement property on the commercial side, basically any non-structural component now can be 100% expensed in the current year, whereas previously it was going to be 40% expense in the current year. So they changed that and now brought the 100% back, which is a big deal. So, this is where, cost segregations are going to come into play, where you see like the real big hit in depreciation and loss from an acquisition of a property. The property had to be purchased after the inauguration, so January 20th. And so anything in those 19 days previous won't count this year. So if you're unlucky, it is what it is. But this is a big deal. It really will help stimulate real estate investing, improvements, and so forth. And so, and then obviously you get the tax benefit to offset income. So it's a good deal. I kind of put a couple little things in there just because they're related to real estate, but this isn't likely something that this group would run into. This would be like high-end investments, but basically the opportunity zones, there's these zones, there's some around Omaha, they're all kind of low income and housing areas, and even commercial areas that need revamped, kind of desolate. There's an investment where you can have capital gains. You can take that capital gain and instead of 1031ing it, let's say it's like a stock sale, so it doesn't even have to be real estate. You can take that capital gain and put it into an opportunity zone, defer that gain, potentially get step up in basis, get some other benefits, some tax benefits to reduce any gain in the future. There's some timing. There's a ton of regulation components that go along with this. And so but it's something that's out there. They extended it, they revamped it a little bit. And so, so if you have, I don't know, Berkshire you've owned for 40 years and you want to sell it, you potentially could take that gain and put it into something like this. Okay, so farmland also received a little bit of a change in the tax law to help farmers who are older and need to sell their ground and don't want to pay the tax initially. So they can now take that ground and sell it to another farmer. Has to go to somebody who's going to actually farm it, but they can take their gain and spread it over 4 years. And so that gives them the ability to not take the huge hit initially. It gives them some deferred cash flow, and so it's a pretty good deal. But again, it has to go from being a farm to staying a farm. So it can't be you sell it to a developer and you get this. That's not going to work. Okay, so when the OB3 came out, there were some things that were going to go away. One of the big things that was going to go away was this QBI deduction. It's also referred to as this 199A deduction. But basically, that deduction was going to go away. They now have made it permanent in the OB3. So think about like the things that we were going to change, and we were going to have to revamp everything, and everybody's going to have to redo their structure because the whole tax law changed, and we were structured around one planning, and now it's different. That now has gone away, so we don't have to worry about it. I don't know what happened there, but slides aren't important. So anyways, I guess this just is for me now. But Okay, so the 20% deduction is basically for any qualified business income. It's been around for the last few years, so it's likely something you've seen on your return, but there's some tracking things that go along with it. There is some income limitations, and so if your income goes above 500,000 right about, then you could phase out of it, but there's other items that will allow you to use it. Like if you have wages in with your business, then you could use those and you won't phase out of it necessarily. If you own property, there's this UBIA calculation, which basically takes like the adjusted basis of the property, and then if you're on a phase out, it allows you to take some of the deduction, potentially all of it. Depends on how much of a deduction you get. But a lot of this, like some of this goes into planning and structure and documentation as well in the type of business that you're running. And so that's where, entity structure comes into play, and just making sure that you're taking full advantage of it. Sometimes you get a better advantage if you're just a sole proprietor, it's just pastor. Sometimes you get a better advantage if it's an S corp or a partnership. It just depends. It depends on the type of income, how much income, do you have wages, no wages, do you own property in it? It's all of those things come into play as you plan around this. Excess business loss limitation. This is also extended and made permanent. This is one of those things that some of my investors run into because they may buy into a very large property and they have this active income. When you do that, there's a limitation on how much passive losses you can offset active income. And so there's this limitation, this calculation that goes into it. And so for married filing joint, like if you had a loss, you can't offset more than $626,000 of income. Colton, you got a question? I think you got to turn it on. There you go.
How the business loss limitation also affects being classified as a real estate professional when you're managing your own portfolio and all the benefits you get by being able to use the additional deductions to offset your AGI. Is that?
Losses don't necessarily change the character of that income or loss, I suppose. Like when you're talking about being a real estate professional and being able to take losses from real estate and offsetting other income, right? It doesn't, you still are, the real estate professional, you go through that, you make that income, you make those losses non-passive. But let's say like that income item, if you had, so you had a spouse that had $1 million wage and you're trying to create all these losses to offset that wage, that would you would be limited on how much you could offset that wage, right?
I think the background of my example was, high income spouse. The gentleman also is very high income as well. His W-2 gig also ties into real estate directively. Mm-hmm. And then he also has, the passive income between him and his wife from all their real estate holdings. But then he also does like a flipping business on the side. Yeah. Through a different schedule there.
Yep. So I mean, all of the real estate activities, particularly when you make the real estate professional election, like a lot of those are all like business activities that are all going to net together when that loss is calculated. So you wouldn't necessarily be limited by this excess business loss limitation. It really comes into play when you have a non-real estate oriented income that's active. You can only offset that by a certain amount. And so that's really what this limitation is for. Now, if you are limited, like it carries over and it becomes this NOL, a net operating loss, and it has the same characteristics of that moving forward, which has some limitations to how much you can actually deduct in a current year. It's a 80% of your taxable income limitation. And so once you have fallen to that, then that just kind of rolls forward. But it also has like the same, even if you don't have an excess business loss limitation and you take all these losses and you create an NOL on your personal return, when it rolls forward, it has that 80% limitation of your income. The same thing as if you had an excess business loss. The NOL and that loss limitation will basically have the same character as you move forward into the next years. So really, like planning around that, you may not want to do a cost segregation in the current year because you're going to be limited and it's going to create this loss, and then you're going to have this 80% limitation rolling forward. So you may choose to wait a year, or do like, if you buy multiple properties, maybe do one property instead of all 3 or 4 of them, just to manage your income and get it down to a certain level. I do think it's important to kind of talk about like the efficiency of deductions. The OB3, what it did, it also like rolled forward all of the tax rates and the brackets. They're all indexed for inflation, but the percentages didn't change. When you take deductions, you don't want to take a deduction that you get no tax benefit for if you can help it, right? It would be better to pay, say, 10 or 15% tax when next year your income is going to be in the 40% tax brackets, right? With federal and state combined. And so if your only effective rate is 10%, well, then why accelerate all these depreciation items? You don't need the bonus. You don't need to take a cost segregation if you're in that situation. So I think when we do all this planning, we want to be efficient with what we are getting. Really, when you think about depreciation, cost segs, and all that, it's a timing aspect. So you're trying to time where your income and deductions are so they net out. And, even though you may pay a little bit of tax, you're getting a bigger benefit in the following years. We've kind of talked about cost segregations there and like multiple ones. I'll make a point on it. You don't have to do, when you buy a property, you don't have to do the cost segregation that year. You could wait 2 years. All that is when you do the cost seg, you're just matching up your income expenses. You file a change of accounting method in that process, and then you get to accelerate the depreciation in that year. So if you had multiple properties and maybe you've owned them for 4 or 5 years, but now you really have income flowing in from whatever activity you're doing now, well, that's when you might cost seg 1 or 2 of them to time the income with the deduction, and you can kind of pick and choose those years that you want to do it. And so that's a good planning opportunity for a lot of real estate investors. Ted got me a old fashioned, so we're gonna start this already. Oh yeah. Okay. 163J. So this is a interest limitation. It basically it limits the amount of interest you can deduct on your real estate. There are some factors that come into play. You're really exempt from this if your gross receipts are less than 25 million. However, there's one caveat to that, is if the entity that you're operating is a tax shelter, which basically means 35% of the partners are not active. If you have losses rolling through a partnership like that, then even though you're not at the revenue of 20 plus million, you meet the classification of a tax shelter. So if that happens, then technically you have to do this calculation to determine if you can even deduct the interest from your financing on your real estate. So they changed the rules on it to make it a little more favorable and trap less people, essentially, less investments. And they basically changed it from this earnings before income and taxes to earnings before income, taxes, depreciation, and amortization. EBITDA normally referred to, particularly for dealing with like M&A. EBITDA is like a key factor for that. But now they made it so there's more income for you to set against the interest, and so that helps. Before there was some workarounds to this, but it was complex, and it required you to change the type of depreciation method you used. And so now they kind of simplified it a little bit. We can still use some of the other techniques to not limit your interest, particularly if you're in like some bigger investments, you get a pool of investors, then that you might hit some of those things. That requires some planning. There's some elections that have to be made. And so it's important to have a good advisor when you're in those situations, particularly, we're in a higher interest market, you get some big investment and you have a lot of passive investors. You have to kind of be wary and make sure that you're not limiting yourself on the amount of interest you can deduct. Has anybody heard of that before? Not very many. Oh, two Frankel guys back there. This is a really simple slide. I don't really have to add too much to it, but basically the administration took all the energy credits and stuff and basically repealed them all. Some of them have some like different lives on when they actually go away. Some are at the end of this year. Some of them, if you had a project, it needs to be finished by a certain time next year. And so there's a few different things there. We don't need to talk too much about it, but if you don't have a project started now, likely it's not going to qualify. And so hopefully you weren't relying on any energy credits to make that investment make sense. Some low-income housing tax credits. They basically just made it so there's more credits available. They still usually are kind of call like industrial, larger syndication type credits where the developers bring a pool of investors together. But basically they just made it easier. They changed some of the calculations on it. So you might see some of these pop up. The states have a little bit more, they have a little bit more funding to do it. And with the change in calcs, you might see this more as it goes. Oops, wrong way. New market credits. This is a similar thing to the low housing credit, but kind of going through like the economic development centers, and they'll set up investments and stuff. It can be commercial and they have a little bit different feel to them, but similar. There's hopefully more that are going to be available, and it's permanently extended as well. All right, any questions so far? All right, we got one. While Owen's walking up, I'm going to take a sip.
This should be a quick question, I think. I saw permanent tax credits, permanent and permanently were in a lot of those slides.
Mm-hmm.
Does that actually mean permanent, or does that just mean until the next administration turns it over, repeals it, whatever? There's not a set sunset period. Is that basically what permanent means?
Yeah, basically, if there's a deadlock, and they can't get anything through, then it just remains. It's not set to like go back. Like some of the initial ones, like the $40,000 SALT limitation, like that is going to expire in 2030 if there is no extender bill passed. If they didn't pass something to make it permanent, or whatever. So like if they do nothing, it goes away. And that was the same thing with a lot of the laws from the TCJA because of the way they passed that bill in like a budgetary bill. I don't know the main lingo, but basically it wasn't unanimous. And so they couldn't extend it past a certain point. And so there's a lot of things that we're sunsetting, and that's why the OB3 is such a big deal, because it kept everything there and added to it.
Got it. Okay, so permanent means 4 years, maybe 8. That's generally what that means, right?
Yeah, I'd say.
I was just curious because that gets thrown around a lot, and you think, and you're, intuitively you think permanent means, okay, this is how it's going to be for the foreseeable future. It's just not actually that way.
Yeah, it's just harder to change when it's permanent, I suppose, but it doesn't mean it can't change.
Yeah.
Yeah.
Okay, cool. That's it. Thanks.
All right. Real estate, as we work through it, when you're reporting real estate activities on your return, on a partnership return, on an S corp return, there are designations that goes with this. And so I thought it was important to kind of talk through a couple of those things. I'll try not to spend too much time on it, but I think it's important to understand that real estate has a number of different buckets that it could fall into. For most real estate, particularly rental real estate, you think about that, like it's always passive. They call it per se passive, and so it doesn't matter how much time you spend in it, it's passive. The only way to make it active is to become a real estate professional, meet all those rules and stuff, which I have in another slide. But it's very hard to for a lot of people to meet those for various reasons. Maybe you have a full-time job, you don't always do real estate, maybe your job doesn't qualify for that. There are some things that would fall into that would make it all passive, essentially. And passive in and of itself isn't necessarily bad, except when you have passive losses, then you have limitations on how much loss you can actually take against your income, active income. When you have passive losses, there are some mom and pop rules, small taxpayer rules where you can take a little bit, but it phases out very quickly. And so basically, you could take married filing joint, you could take a $25,000 loss against your active income with the passive income, but your income can't go above $125,000 basically. And so it phases out very quickly for a lot of taxpayers. That was not indexed for inflation, and so it's coming into play more and more. But for that purpose, it's important to know, particularly in your planning, where your income is, how it is classified, passive or active, and how you can potentially change that. Some of that goes into how much tracking you're doing. You're tracking your hours. Are you meeting the requirements? Are you making any grouping elections? There's a lot of different things that could change the end result by just planning around it. This is the $25,000 rule we talked about. It fully phases out at $150,000 for married filing joint. There's this cool little chart. I liked it. It kind of went through a number of different things, but basically a decision tree on whether you're passive or active in your activity. There's hours requirements that you need to meet. There's amount of participation, how much services are you providing in that activity, and some of this goes into what I'm sure a lot of you are doing. Either you have long-term rentals or you have Airbnbs. Well, they're treated totally separate, totally different. They're reported differently. There's facts and circumstances that goes into the designation of how you would want to report it. But if you're turning the sheets every single tenant on an Airbnb, well, that's going to be active. Like, you're going to have to report it in that way. You could have self-employment income as a result, and so forth. So there's like all these ramifications that could come through on that. And there's reasons you might want it to be active, and there's reasons why you wouldn't. Kind of mentioned it before just a second ago with the Airbnbs, but as you look at it on how you report, where you report it, if you own a rental yourself, Even if you were reporting on a partnership, it would be reported differently if it was an active short-term rental versus a long-term tenant. The main thing on this is, yeah, if you do have Airbnb and you are providing substantial services, you're doing the laundry, you're turning the sheets, you're just like a maid service, right? And they're only there for 7 days, it's less than 30 days, then basically it's an active business. The big thing about that, and we'll actually talk about this later in a case, but those hours associated with it likely will not qualify you to be a real estate professional. There's some cases that came out on it. There were some arguments made, and more likely than not, you can't include those hours on those Airbnbs as a real estate professional. Speaking of, a little foreshadowing. So real estate professionals, the only way to take a passive rental activity and turn it into an active activity, you have to meet some certain rules. You have to, for instance, you have to work more than 750 hours in a year on real estate. You can't work more than the amount of time in real estate in something else non-real estate oriented. If your business is if you're working and you have a W-2, if you're not more than a greater 2% owner of that entity that you're working for, then all those hours don't count. And so there are a number of different nuances to this that you just have to track and make sure that you qualify for them before you plan on taking any passive losses against any active income. So like we kind of talked about 750 hours and those requirements. Let's see. So this is a case I just thought was kind of interesting. I think we've talked about this once before, but trying to be a real estate professional, you got to know and make sure that you're documenting that is right. There's a lot of penalties for not meeting the designation or not having the support for it, and then it being clawed back on you. If you think about, like, if you're a real estate agent and you own your own S corp and you're running commissions through there and you're also flipping houses and you're doing all of that, like, you might not have to track your time as much because it's pretty cut and dry that you are a real estate professional. But if you have a part-time job and you have a bunch of Airbnbs and you also are a commercial flipper and developer and you're doing all that, like, well, there could be a case that even though you're doing all that stuff, that you don't actually qualify as a real estate professional. You need to make sure that it's pretty clear, and if it's not, then you have substantial, you have contemporaneous reporting, your hours tracking essentially on what you're doing, how much you spent, how many hours you spent on it, and that you're meeting those requirements. And so it's just important to know you can't just you can't just say you're a real estate professional and go through it. And by the way, like, there is like an election that you need to include on your return when you do that. And that's an annual thing. The cool thing about it, though, is if you're married, only one person actually has to meet the designation. And so that's pretty important. So you can plan around that. One person's high income earner, the other person is a real estate professional, and you're buying a bunch of real estate. Well, then you can offset the income from the other if you plan it right and you take, and you're improving property, you're buying, you're doing the cost segs and stuff like that. You might run into the excess business loss limitation rules, but you're still getting a pretty good benefit at the end of the day because you're getting losses for appreciating assets, which is not a bad deal. We kind of talked about this with the short-term rentals. Anybody have any questions on active, passive, short-term rentals, all that stuff? Yeah. I think you might want to talk it to the mic, or Ted's going to yell at you.
I work for a builder, so I'm a W-2.
Okay.
And my current tax provider says I cannot classify, but I have rentals. I have multiple rentals. And he says no. But I know I'm putting in more than 750 hours. And I feel like I can document it, but do you think I'm swimming upstream? That's not.
Your problem is you can't put more hours in on your job than you are on the real estate. You could meet the 750 hour requirement. Yeah. But when you have a W-2 job, you would have to be working more than that. And it's essential. Like there's court case after court case. Like it's basically not going to happen.
So is it more advantageous, since I have some sizable losses, to maybe go back to 1099 and not be a W-2? Would that change?
It could, but it doesn't change the character of the previous year losses. And so the previous year losses are still going to be passive losses.
Right.
And then the current years would be active if you make that election. So if you think
only
about
that year's active losses would apply?
Yeah. So think about it, like if you have, I'm going to make up a number, let's say you have $50,000 of passive losses, then you become a real estate professional, you become active.
Yeah.
Well, now the character of the gain that you may have over on this side doesn't match up because you have active income, passive losses, they don't match. You need passive income, passive losses to offset each other. And so you may or may not, it would not be advantageous to go through that process if you know that your real estate is going to turn the corner and start generating profits. Then it would be, you would offset, all the income would offset from the prior year's losses.
Right, because I'm getting more and more income now. So then maybe that's why it doesn't feel as painful right now, because I'm not being able to take advantage of the losses.
Yeah.
Okay.
Yeah.
Okay, I think I get it.
I mean, it's common, W-2 employees who start investing on the side, you will accumulate losses. That's kind of how it works. But then at some point, you get to use those losses. You can use those losses when you have passive income, and maybe you could find an investment that actually does generate passive income for you. And then you could use that to offset it, so you kind of can go back and forth, but you got to plan for the character of the gain and the loss and make sure that they're matching up.
And then in that, not a question, statement, I guess, but in that situation too, without ownership is how they block you, because you have to have that ownership you mentioned. So that's what's going to block it. Like if you're a building contractor or something, you should talk to your tax professional about making the real estate professional designation possibly, right? If you own that company, just because you had rentals and you own that company, we might be doing a grouping election for that. Like it's different because of the no ownership.
Yep. If you're W-2 and you don't own more than 5%, you're SOL. Maybe if you're only working 15 hours a week and you're doing real estate the rest of the time, you can document that, and you're definitely spending more time on real estate than you are your W-2. So then it would work. But as we kind of revert back to, you have these passive losses, and passive income is going to offset it. If you ever say like, hey, I want to sell this property and upgrade to a bigger property, well, then when you sell that property, you'll have passive income and it's capital. So you get to release all the losses potentially. And what the cool thing about it is you get active losses, you have capital gain income. And so when they net out, you get to offset your ordinary income, and then you only have to pay capital gain rates on the gain. And so you could see this arbitrage in tax rates where your effective rate, and actually have an example later of this, that your effective rate is could be nothing, depending on how much loss you have and how much gain you had on the sale of the property. So it works. It might take a little time. So you'll see a little pain now in your cash flow because you're paying tax on your ordinary income, but it does revert. Yeah. I remember a case where I had real estate professionals who owned, say 60% of a property, and then a individual who owned the other 40% who wasn't a real estate professional. And all these losses were accumulating. And it was 10 years down the road, they sold the property And the guy who was not a real estate professional all of a sudden didn't have, like, had a bunch of income but had no tax because of the suspended losses that were all offset. And the other guy was pissed off because he had to pay a bunch of tax. I'm like, well, you got all the benefit over the last 10 years. And so, you know, depends on your perspective. Let's see. This is a case I referred to a little bit ago, but this is basically supporting the argument that the short-term rentals, they don't qualify for real estate, for your real estate activity. So if you have Airbnbs and long-term rentals and you're trying to track your hours because of some other activity you have going on, then you will not be able to include the time that you spent on the Airbnbs in your real estate professional election. Okay, so just keep that in mind. There's a number of different cases. This one's kind of a more famous case, but it just illustrates the point that you got to know the buckets and track it well, or you could get caught. I just got to put up the lives of depreciation. These are the type of things that, you know, when you do a cost segregation, you know, this is what they're doing. They're taking a house, which would normally just be 27 and a half a year without a cost seg, and they're separating it out into all these categories. You know, same thing with commercial property. Commercial property would be a 39-year life. You do a cost seg, and they separate it out into all these categories. What it does is anything that's 15 years and less, you get to use bonus depreciation on. And that's when we go back to, you can take 100% of it in the current year. And so that's why you do the cost seg. This is what the benefit is and how it is carved up. But without the cost seg, you can't do this. Now there is, let's say if you buy a property that's distressed, you know, you paid, I don't know, 30 grand for it, and then you put $200,000 of improvements in on it. Well, you can do a cost seg on that, but a lot of the times you have all the detail. So if your contractor and yourself track all of the expenses associated with it, then you know exactly where the categories are. So if you plan it well and you track, you don't need a cost seg to do it because you have the detail already. And so if you had one contractor and they gave you one invoice and didn't carve it up, well, then you'd have to get a cost seg for somebody to carve it up for you. And so that's why when I'm talking to particularly like commercial owners who have these tenant improvements, I always tell them, like, you got to talk to your contractor and do not give me one number. I need it broken up. And don't give me just like a list with one number. That doesn't help. I need it broken up into each category so then we can avoid having to pay somebody to come in and tell us what it is. I feel like that's part of their job, honestly. But you have to school them ahead of time or they won't do it. We just talked about cost segregations. Everybody knows what cost segregations are, right? How about a show of hands, like who's actually done a cost segregation on one of their properties? What?
Hey, Jordan, can I ask you a quick question? What constitutes work for qualifying for this? Does worrying about things fall into that category? And I'm only half kidding with that. But if you spend time thinking about things and putting things together, does that qualify? Is there a hard and fast rule about, okay, you clicked an email or you typed an email that took 5 minutes? Like, where do they draw the line on what exactly constitutes activity?
What about talking to ChatGPT? Like,
Yeah,
Ted.
I appreciate the very easy question here, guys. So I actually have a memo about real estate professional and like what qualifies and what doesn't. And a lot of times, like if you're online, you're just looking at Zillow, you're profiling houses, you're like doing that stuff. Like that's investor activity. That's not real estate activity. And so I'll make the rules. Don't look at me like that. But yeah, so scrolling around at night on Zillow, that won't qualify.
Watching HGTV, where does that fall?
If that is a qualification, then my daughter is a real estate professional.
Hey, Jordan, question on if an investor wants to maximize the bonus depreciation, what does the ideal property look like? So is it a small house with a huge parking lot, a bunch of retaining walls, a bunch of land improvements? Like, so it sounds like the goal is to find something with a bunch of components with a depreciable life of 15 years or less, so you can depreciate it right away. Is that the way we should be thinking? Should we seek out properties with those characteristics? Like, tell us what the ideal property looks like so we can maximize that benefit.
Okay. So
you drink your old fashioned, yes.
What you'll find, there's a cost to doing cost segregations, right? It's in the name, but you have to pay somebody to come in and like carve everything up. So you need to have like Jim was referring to, like there has to be enough there to create a big enough expense that you can accelerate that now, get a current tax benefits. We're talking about time value of money, essentially, that you're offsetting income, you're getting an actual tax benefit for it, and therefore the cost associated with that is worth paying, because all we're doing, like you're not getting more deductions. We're just timing when you get the deductions, because you could just let the commercial property depreciate itself out over 39 years. Well, it'd take you 39 years to get the benefit for it. And, I just turned 40, like 11 months ago, but, but that's a long time. That's a really long time. And so I'm not a patient person. You can ask my staff. But so if you could take that and accelerate it now, and there's enough there, then it makes sense. Now, the type of property, a lot of cost segregation companies may come in. Like if you're doing a true cost segregation, like one that will stand up under audit, there are specific rules that the IRS goes by. They have to do a site visit. They need to, usually done by an engineer. They're carving things up. They're like truly doing a study. Therefore, and they will give you a report, it backs it up, it goes through everything. That costs quite a bit to do. So the type of building that you would do it on, traditionally, like I would say, somewhere around 500 to 700,000 is like, you really wouldn't do one below that. You could, there are companies who will do it and they will stand by it, and there are risks associated to a lot of positions. But the main thing is single family homes of low value, there's not a lot of juice to squeeze on that. And so the tax benefit is pretty small. The bigger you get, the more units you add. A 40 unit apartment complex, they'll go in and look at, maybe there's two types of room, a 2-bedroom and a 3-bedroom. Well, they'll look at that, they'll analyze it, they can then extrapolate it, and the benefit is huge because there's a lot of personal property inside those. Each one has its own air unit. Each one has like all the appliances, and all that stuff, and they can take that and extrapolate out. When we're talking about residential rental stuff, like that's where like there's a huge benefit. You have a big parking lot that's sitting there. Well, that's a big benefit. Big retaining walls, stuff like that. Like that would be carved out, and it's in the lower class life, so you can accelerate that. On the commercial side, office buildings, like manufacturing is like a really good deal. Restaurants, there's a lot of, like, when you think about cost segregation, like the type of stuff like electrical units that are going to specific pieces of equipment, like that whole unit going all the way down to the breaker, that qualifies as lower life property. Just because it's maybe it's a special light or whatever it is. If it's going to like a piece of equipment that, even though it is affixed to the building, but it's a single purpose type of asset, well, then it qualifies for a lesser life. So you're looking for real estate that has stuff like that in it. Commercial buildings have a little bit different flair to it. If you have a building like that with multiple bays, you could have tenant improvements and stuff like that. And all of the things that are inside the building that aren't structural in nature, they qualify. And so they'll carve all that stuff up and you can take pretty big deductions on it. If you think about anything that's non-structural in a commercial building, well, what do you have there? A lot of it's like a shell, and then they build all these walls and all this stuff all around it. Well, that's all tenant improvement and it qualifies. And so there's definitely more deductions available on the commercial side than there would be on the residential side. But it doesn't mean that it doesn't make sense on the residential side. It just might be a little bit more limited than you would see on the commercial side. That's all right. I'll repeat it. What's up?
Tenants with disabilities, like the ramps in front and remodeling inside, it's kind of costly to make the cabinets wheelchair accessible. Redo it so they can reach.
That's good. Okay, so the question is handicap accessible type of improvements, ramps and lowering countertops and expanding bathrooms and stuff like that. Yeah, those would qualify. They would be treated differently if it was a commercial oriented versus residential. But that doesn't mean it isn't something that you can accelerate the depreciation on. It depends on the improvement itself. If you're redoing an entire room, well, removing walls and stuff, and you got to move all this stuff. Well, that's treated differently than if you are just putting in a ramp outside, right? They're a little bit different. If it's in a commercial side, it's all considered tenant improvement for the most part. And so it's not structural or anything like that. And so you would be able to bonus it in that regard.
Those chairs they sit in, so they go up and down stairs.
Yeah, no, the chair lifts that go upstairs stairs. Yeah, that'd be personal property. It's not structural to real estate, and so you can remove it. So that would qualify for a lower life 5-year in that case. Yeah.
All right. Just a quick question, right along with that. Could a well-written purchase agreement establish those if it's done right for the buyer side? So when the buyer then purchases the property, that would establish that. So you wouldn't have to go through a cost segregation study?
Potentially. A lot of those happen in M&A deals. And it could come into play when the seller has a cost segregation that's already done. But you have to remember in those deals, and this gets a little nuanced, but you're agreeing to, the buyer is agreeing to treat it one way. The seller is also agreeing to treat it in the same way. There's actually a form that you fill out, particularly in business sales and stuff like that, where you're agreeing to treat a certain amount of the purchase price in different buckets. And so that could qualify. I usually only see that in business purchases for the most part. But I don't see why it wouldn't work. It would you'd have to have support for how you're getting to there. So facts and circumstances does come into play. So if you're trying to manipulate the system and, the other guy has no real skin in the game, I suppose, because of whatever situation, well, you can't treat the entire property as 5-year property, right? So there's a reasonable test that would go along with that.
Couple quick questions. Well, one quick one, maybe a little more complicated. You said you had a memo or a form that describes and spells out different qualifications.
Yes.
For a real estate professional. Can we get a copy of that through TED?
Yes.
Okay, awesome.
Give you more work.
Well, I mean, I don't know if you want to receive emails from all of
Yeah,
us.
so I mean, honestly, so the memo, which you may find interesting, and then I'll let you finish your question, but it's in a situation where a taxpayer has a spouse that is a stay-at-home spouse, and they have all this real estate, but she doesn't participate. And so it's drafted in a way to say, okay, here's what you have to do, and here's what qualifies, and here's what doesn't, and this is how many hours you need to work per week. You need to log this every single week. And, we set up like a little tracking system for them, but like the deductions were huge. And so it was worth it for them to go through that process. That's how the memo is set up. And so it explains what you need to do in order to qualify and all of the different nuanced things that would qualify and the things that don't qualify.
All right, and then I wanted to touch base on the contractors separating out the different categories. I'm personally a contractor. I do that. I'm wondering if I'm doing it correctly. I'll take framing as a section, drywall as a section, electrical as a section, and so on, right down to cabinets, hardware, blah, blah, blah. Do I need to be more in depth on that for the investor, or is just breaking it that far out good enough?
How much more would you break it out?
I mean, individual appliances, individual hardware costs.
No, the categories that you're talking about are perfectly fine. Now, if you were like, if you're taking, you gutted the kitchen and you're replacing it, you can't just identify every single screw and, it's kind of like a unit, right? So I think what you're doing is correct. You're not getting too nuanced, but you're giving them the opportunity to carve it up themselves as well. There are depending on the type of work you're doing and the type of improvement you're doing, that would matter. But there are de minimis elections on that. So improvements that are under $2,500, you can make an election and return, and you get to expense anything under that mark. You don't have to even track it. You don't have to worry about it. It's on a per item basis. So if you think about like I'm replacing some doors and they were $1,300 a piece. Well, collectively they're over the 2,500 limit, but there's two doors. You can carve them up between the two individual doors. So per item basis, you could potentially expense that.
Okay, so the benefit is, where do we draw that line? Can you take that all the way down to a single family home? When I'm working with an investor, which I do on occasion, they can take that invoice, which is billed out in those categories, and just use that as their deduction.
Yeah, they can use that as support in order to claim a deduction for it, how they want to classify it. Depending on how big of the project is, that's where you get into did you tear down something that was usable already, or did you take a blank house and you got it all up and running? That's totally different situation from fixing a bathroom to renovating an entire house. So that in the circumstance of you taking an asset that is not in service, meaning nobody is renting it out or anything like that, it's not even being depreciated because of that fact, the rules are different.
Yeah.
And so you have to take that into account.
Yeah, it has to be for the investor. In most cases, it's 40,000 and up.
Yeah. So they wouldn't be able to just go by a per item basis and expense it, but they could go by a per category basis and say, okay, my flooring cost was 10 grand. Great, that's 5-year life. But all the electrical, that's 27-year life. You can't do anything about that.
Yeah, exactly. So that I understand. All right, perfect. I guess my price will go up.
All right. Yeah. Okay. Am I good on time, Ted? Yeah. Okay. So we're just going to talk about 1031 exchanges real quick, and then I have one other topic, and then I have 2 case studies, and then we're done. And you guys can go. Or if you want to leave beforehand, I don't take offense. It'll be fine. Yeah, I'll just keep talking. Okay, so like kind exchanges, you're taking real estate, it's got to be real property, and you're exchanging it for other real property. Big shocker. But that used to be where you can do personal property, and that's where it changed a number of years ago. So now it's only real property. It doesn't matter the type, character. So you can take farmland, you can put it into an apartment. So you can kind of, as long as it's real property, then it's going to qualify. If you did a cost seg and you have all this personal property identified, well, that personal property doesn't qualify. So you kind of got to know what you're exchanging. There's some strict rules to this. You have a limited amount of time. If you're doing a normal cost seg, there are a couple different types. But if you sell a property, you've got 45 days to identify a new property. You can identify up to 3. You can identify more with a special election, but normally I don't see that. You can identify up to 3 without any real limitation. Then you have 180 days from that original date to close on the property at that point. What that does, you can take the gain, you can move it into the next property, and you don't have any income. There's a basis transfer. So you're not getting a step up in your basis. You're just transferring over to the next property. That gain doesn't go away necessarily. It just transfers from one property to the next. When you have a property that you're transferred to, it's important to understand boot. Boot is basically any cash that you receive or any debt forgiveness that you receive. So if you take a loan out, if you have a loan on property A, then you better have an equivalent loan on property B, or you are going to be in trouble. The property B also needs to be of equivalent value. So a $500,000 sale here, you're going to need a $500,000 purchase or more over here, or else you're going to have boot in one way, one shape or form. That boot, it comes on the top. It's gain. No real questions asked on it. So think basically if you have cash that you come out of the deal with in your pocket, that would be a problem. If you have less loan than you had on the original property, that also would be a problem. Any questions on that? Can you talk it to the mic? Ted's going to chase you down.
We'll be real fast. Does that kind exchange have to be within the U.S.?
Yes.
So Puerto Rico, Alaska, Hawaii, is that?
Well, continental U.S. is fine. I can't say I've researched Puerto Rico. I'd say maybe. Okay. My man David, he got me. Where were you at on that, Jacob? Apparently not, but I have not run into it. I've not researched it, so but I'm told no. This is just kind of a diagram. If I think all people are taking pictures, but it's just a good timeline of how things work. The main thing on it, I'll just say, is you got to use a guy like Mr. Midwest Tile over there who helps with 1031s. They would be that qualified intermediary. You can't sell a property, take the cash, and then go buy another one. That's not an exchange. And so you have to have somebody in between you, unless you have a property that you're literally just transferring title to from somebody you know, right? But it's just very rare. You'll never see that. So you're most likely the person you're buying from is going to go buy something else, or they have something else. They don't want your property per se. So you have to use a qualified intermediary because of that. And so that's how you kind of establish the exchange. They'll hold your cash. So it's important to have a reputable company do that for you. You don't want somebody to just run off with your money, essentially, because you don't have access to it. You don't have control over it. But that's kind of the principle here. You don't have access, and then you get the exchange, and they give you the title of the next property. I just threw a couple planning strategy here. Estate planning tool, particularly if you're like older, you've got a lot of properties and you're moving them around. You can exchange a group of properties into another property. There are some limits on that, on the amount of properties you could do that to. But a lot of the times, particularly our older clients, part of their estate plan is to literally die with the asset. Because when you die with the asset, you get a step up in the basis. And so the only time you get tax-free gain truly is when you have that step up. So he's just think about like your grandpa had a property that was depreciated all the way down to zero. He's owned it for 80 years, maybe not 80, but at least more than 39. And then he passes, all that depreciation now gets stepped up. It doesn't get stepped up to his original purchase. It gets stepped up to what the fair market value is at the time of his death. And so you'll have, some estate returns to file and stuff like that. So you track the value and all of that. But whoever his heirs are, whoever's inheriting that property now gets to step up in the basis. If they hold it and they put it in and they continue to rent it out or whatever business use it is, but then they get to depreciate it all over again without having any gain associated with that inheritance. If they get the asset and they don't want to be involved in it at all, they could sell it right then and there and they don't have any gain. They just get the cash. And so that's one of the estate planning tools. So if we have somebody older and maybe they have a property that they no longer, it's a lot of work, it doesn't, we'll basically sell that, transfer it, put it into another property that is less maintenance potentially. You put it into, or get too technical, but you can put it into like a Delaware statutory trust. So it kind of goes over here. It's now off of his purview as far as like having to manage it. It's managed by somebody else, still gets the gain transfer. And then, when he passes, you get the step up at that point. And so we use that as an estate planning tool in this process, in the planning. So we're obviously getting tax-free treatment. We can diversify properties from, farm ground into an apartment building or vice versa if you want to, or to some sort of development, so there's a lot of flexibility in diversifying your portfolio if all you have is single family homes or something along those lines and you want to change things around. We talked about boot on the gain, so covered there. One of the things that I've run into for a number of years now, and I really just have some problems with it because of the lack of knowledge going into it. So I wanted to provide some information on, well, it happened again, on self-directed IRAs and using those IRAs for real estate investing. There are plans out there, one's like goes by the acronym of a ROB plan, where you take your assets and you put it into a self-directed IRA, it then goes into a C Corp, and then the C Corp would buy a business that you then operate. That's not exactly what you need to do for real estate, but when real estate is involved, I think you have to understand why you're doing it. When real estate goes into an IRA, you've got to think that, the IRA is there to, you put money into in your working life, it grows, is invested, and you then take it out later. When you put it in originally, you're getting a tax deduction for that. When you take it out, you're getting ordinary income. And so all the time in between, like what does real estate do? Real estate appreciates and it provides you with deductions. What happens to that appreciation and deductions inside of an IRA? You get no deductions, you'll get no losses, nothing offsets, it just grows and appreciates. And then at some point you take it out. You don't get capital gain treatment on the takeout, it's all ordinary. And so, and there's a lot of traps inside of the IRA. You can't operate it, you can't directly benefit from it. There's a number of different problems in there that nobody really talks about. When you have a loan on real estate inside an IRA, you have what's called, gosh, what is it all blinking? You have unrelated business income because debt is in there And so that causes a problem. You could pay tax on that inside your IRA. So there's issues that come along with it. And my main point here is I think you have to do a bunch of due diligence when you do take the advice of somebody who is trying to sell a self-directed IRA product because they don't tell you about all those little things that come into play and the planning, the long-term planning that comes along with it. The situations I've run into, clients want to do it. I talk to them, we decide this, listen, the funding comes from the IRA. I understand that. We need the cash. But a lot of times you can create enough of a loss from the real estate. And if you're in a certain situation, if you are a real estate professional or so, you can take the cash out of your IRA. And yes, you will pay a 10% penalty when that happens. But now you have no limitations on this. And if we plan it right, we now have all these deductions that offset that income. And so now we don't have to worry about all of the issues that come along with it and the downfalls of it. And so my main point is just know why you're doing it. There needs to be very specific reasons why, because there's a lot of negatives that come along with it that a lot of people don't talk about. I have a quick case study. I think I have 5 minutes maybe. So this is something that I've actually run into a number of times. Maybe the numbers are a little bit different. I don't know what happened to my slide, but you're just gonna have to work with me on here. I swear they weren't lined up at one point. But I had this taxpayer comes in. We did some planning. They had wages. Their spouse had wages. They were also a real estate agent, so they had some S corp income coming through. They had some depreciation. They bought a vehicle. They had some software costs and some other things that came into play. They also owned a bunch of rental properties, so they had a $38,000 loss from depreciation and improvements that they had done to it. They also sold a property. Now this is where the planning comes in, because what they were going to do is they were going to sell that property, do a 1031 because they didn't want to recognize the gain on the $78,000 of gain on that property. But after we looked at it and we realized like where their situation was, we decided not to do the 1031 at all. They had AGI, adjusted gross income, of $120,000. Once you get to that point, like doing the analysis before you move forward is just really important, because what ended up happening to this taxpayer is not only did they recognize all that gain, reset their basis on their property and everything, they ended up with taxable income of $87,000. They paid tax of $1,500 because capital gains have a 0% tax bracket when you anywhere between 0 and 94,000. So that's a 0% bracket there. If you plan it right and you offset your ordinary gain with losses and you have capital gains sitting there, the capital gains sit on top of your ordinary, if you think about it. So they end up having like $12,000 of ordinary income, and they had $84,000 of ordinary and of capital gains. All that capital gain was basically 0% tax. And so that's where the planning comes into it. That's where real estate is cool. There's so many different options you can do for it. We could have deferred that gain. We could have done something totally different and had a very different situation. And the funny thing is, if we would have deferred that gain, their tax would have been the exact same. But now we get deductions for the property that we purchased. We reset our basis. We now get to depreciate that $87,000 over the next however many years, and we move on. And that's where planning is important. We had another one, but I think we're out of time. We good? All right. This case study is actually not my case study. This is my man Jacob's. He's going to come up. He's going to tell us about this case. This is something that he dealt with. And so, yeah.
So cancel my interpretive dance and all the dry ice and everything. We're out of time for that. All right. Yeah. This is kind of a combination of a couple of them. I would say the biggest thing to take from this is like, if you come to us and you want help on your taxes in 1 year, that's kind of hard. People make dumb mistakes. So we catch stuff a lot and look like a hero, but like you want a long-term strategy. Like if you're paying for an accountant like us, like use us and tell us what you want to do over 10 years, 20 years. Like taxes is a long-term play. It's not a, oh, I want to pay the least in taxes as possible. Like taking bonus depreciation or the joke that people say, oh, they just tell me to buy a truck. Well, you buy the truck, you sell it next year. Now you owe a gain on that full amount because we told you to take bonus this year. If we know you're trying to sell it, we wouldn't have told you to do that. So quick example on why. So the reason this worked is because we were actively involved. But this person, kind of unique situations, like they had a really good 401k. That was a traditional 401k from their previous job. They wanted to be able to take that out, convert it into a Roth so they're not paying, or well, they're going to pay ordinary income on conversion, but do it quickly and kind of get it into Roth. So they made a real estate professional designation. And then from there, we could then do these cost saves and bonuses. So kind of goes back to what Jordan was talking about. You know, is it permanent? Well, we knew it was going away. So like on certain years, we didn't do this hoping that bonus would come back. Now we have the playbook where we know we can continue to do it. But we're taking cost saves, taking bonus because bonus can take you into a loss. And at the same time, we're converting that traditional. So we're taking that retirement money out and then we're offsetting it with the loss we're getting from these buildings that he could only do in retirement because he needed to have enough time to be a real estate professional. So unique in that regard, but you can still understand the idea of like, I know I'm going to have lower income or higher income. What can I do to change it? We'll switch to a slide there. And then from there, what he did. So this is kind of why I call it death and taxes, because you can get out of taxes if you die. The IRS is very generous in that regard. They will allow you to do that. And Jordan talked about it earlier with estate planning, but we do these cost saves. We would plan out, okay, what bracket are we hitting? How much do we need? So we didn't get caught up into an 80% NOL or it not being usable. And then once we did that, we do 1031. That way we could get into another property and do a cost save again. We're deferring it. Now, generally, that deferral eventually catches up with you, right? Like Jordan talked about, you're paying it eventually. In his case, his plan then, well, with one of them, he's still doing it. The other guy, now he's just chilling. It's done. He got his retirement out. It's all in Ross. When he passes away, his kids will get a step up in fair market value. No one will pay taxes on it, and he's good. The other guy's still doing it and actually enjoyed it, so he's doing a lot of them. On the cost save point brought up earlier, the best I've seen is commercial buildings and restaurants, especially if you got a big parking lot. But a lot of times they'll give you a bid that tells you pretty much what your deduction will be too. So I wouldn't be hesitant just to ask and see what they're going to charge you, because a lot of times in those emails I've seen, it's like, and here's what your deduction is likely going to be compared to not having it. So you can kind of do the math on your own. Like, all right, is it worth it to me? You know?
Oh yeah. We could go on for a while, but I think we're good. We could take a couple questions here before we go.
Mine regards the 1031. So I've got a situation. I've had a house for about 15 years. It's a rental. We own it in an LLC. We've agreed to sell it, but I want to keep it. So one question, can an LLC quit claim to an individual, and what kind of repercussions would that be tax-wise? Or can I myself be the person to buy it from my partner? And if so, what kind of a 1031 would I be eligible for if I'm buying the same property back? Because it's technically.
Okay. Okay. So when you buy let's just say you buy the property from him, like you're not the one who has to deal with the 1031. Your partner does.
No, the partner's all out. They're selling. We're selling it together.
Right.
So like if we put it on the market and sold it to you, we would have capital gains.
Yep.
Instead of you, I want to be the one to buy because I want to keep it. It's a good rental.
Okay.
So I'm taking the money from I don't know. What would you do?
So, okay. So you have an asset that you like, but your partner doesn't, he wants out.
Right.
And so like your best case scenario likely is to buy the LLC units from this individual. He'll pay capital gain tax on that, depending on whatever his basis is inside there. You will, as it goes, like there's an election you'll make, but you will get a step up on basis on half of that property when you do that. So you will be able to depreciate the asset again, essentially, well, the other half of it at least. And so that basis will be reset for you. You can't take the property and do an exchange inside the LLC like that. He can't take his units and exchange it in any way either. If you took the property out, let's just say you did that, your outside basis now becomes part of the equation on that property. Your partner may have debt forgiveness, so there's some other issues that could come into play for him.
There's
in
a
that
lot
situation.
of issues.
So the best case scenario is determine what the fair market value is.
We have.
Assign that to the value of the LLC units, come to an agreement on that, and buy his units out. Then after that, it becomes a single member LLC for you, assuming you didn't make an S Corp election or anything like that. But the partnership basically is done. Once that happens, it's done. So you'll file a final partnership return, and with that, you will reset your basis. So you'll have kind of two basis line items for that property at that point. It's a single member LLC, so you don't have to file a partnership. Now you just file it on your personal return as a Schedule E rental property, and then you move on. Your partner, on the other hand, will have gain depending on whatever his basis is, and you also have to take into account whatever the debt is on that property for him. So he will have a bit of a calculation to do on what that gain is. But after it's all said and done, you will own 100% of that LLC unit, and he'll have gain because he wants out, and he'll have the cash to pay for whatever gain he had associated with it.
Great. Thank you.
Any other questions? Okay, we got a question. Of course, Owen.
I just asked the questions that most people have and they're afraid to ask. Okay, so this might fall outside of your purview with tax planning and so forth, but I'm going to ask it anyway. Anybody in here self-employed? Anybody go out to Marketplace for insurance? You have to go through that whole rigmarole every year. This is exasperating to deal with because for a self-employed or a business owner, you have no idea what you're going to make from one year to the next, right? Mm-hmm. So I had this conversation with my wife all the time because she's the one dealing with the insurance agent. She's like, so what do you think we're going to make in 2026? And I'm like, I have no idea. And I have no idea how to even answer that, but they force you to provide an estimate. So I guess before I get too long-winded here, is this something that you can talk about related to taxes?
Yeah.
What? Anybody else have this problem? Okay. So what advice do you have? Because like our premium personally is going to go from like $700 a month to like $2,000 this year because, ton of write-offs, cost segregation studies in 1 year. Next year, a couple of sales, regular income from business.
Yep.
Like, what do you do? I mean, how do you operate like that as a business owner when you could have 30,000 in premium 1 year? Or 24 to 30,000, and another year may have like $7,200. Like, is there something I'm missing?
There's planning. Planning is key on that. Like, what I would suggest doing, honestly, is, for whatever insurance you sign up for, like you're planning on paying whatever the full premiums are, even though you might get the premium tax credit on it if your income is low enough. But you need a plan for potentially having to pay that all back. Mm-hmm. Now, you do get a tax deduction for it, so there's a tax effect to it, but it doesn't really make it feel better, right?
No, it does not.
I've got clients on both spectrums. Like, some of them are like, we're keeping their income as low as possible. They're near retirement. Maybe they retired early, and so we have to plan around that. And we're basically using the premium tax credit income limitations to determine how much income we can actually have in a current year. And so they know it, and if they go above it, then there's nothing I can do for them. You just have to be prepared to pay it. And there is there is a pseudo cliff when it comes to it. So once you hit 400% of the poverty level, you're paying 100% of whatever those premiums are.
So just basically plan to pay through the nose for it and hope for the best.
Yeah.
Or
plan for the worst, hope for the best.
No. Okay. One follow up to that. So HSA accounts, like we've met with, a couple of different financial advisors. They're like, yeah, we talked about HSAs, how that comes into play. I've got a wife and 2 daughters. So, and I'm a typical male. I never go to the doctor. Like I don't even have a doctor.
Yep.
But we're trying to plan for those type of, expenses. It's impossible to find a plan that actually allows for an HSA that fits into everything else you need. Is there anything you can talk about related to that, or is that getting a little out on the limb?
I mean, I think you have to go and talk to like an independent insurance individual.
Do we have to? No offense to any of them. Sorry.
It is what it is.
Okay.
If you want to fit into the specific, marker, you just have to. And it's complicated, and it's not something I'm a specialist in. I just know there's pretty heavy repercussions if you.
Okay. Thanks for nothing.
Just kidding.
Yeah. Yeah. Thanks a lot, Owen. All right, listen, I just want to thank you guys for sitting through me just doling on here. Hopefully you got something from it. We obviously have, we have a lot of staff. We have a lot of very talented tax professionals at Frankel. Some of them are sitting right in the back right there. If you have any questions, there's cards or contact. I think we're on the websites and stuff. Feel free to reach out. We'll do what we can to help you. We kind of talk like the hour free is kind of an interview both for you and us to kind of understand where you're at, what your positions are, and give you some advice in that session. And then to kind of go from there. And so I know that you respect our time and we respect yours. And so we will be honest with you when we talk. We're here to help at the end of the day.
And you guys will be hanging out here and in the bar afterwards to answer any more questions?
For a little bit.
Yeah, for a little bit? Okay.
For a little bit.
Awesome. Can you guys give a round of applause for Jordan? Couple of things just to wrap up here tonight. Quick announcement too. I mentioned this before. We partnered with Rent Perfect. If you scan this code right here, for 95 cents, you get a property management software. You can take payments, you can do digital leasing, background checks, online applications. Everything's free except the background checks, just so you guys know. And I partnered with them. We agreed to make a deal. Any REIA member does not pay for this software. So take advantage of it. If you do a background check, I think it's like $39. It takes like 9 hours because they actually have like 300 private investigators that do background checks for you. If you're using a property manager, you can work with them on this background check software. Also, it's a benefit for you guys. So take advantage of it. If you have any questions on that, let me know. But the download the app, it's 95 cents, and they're using that just to background check you to make sure that you're not shady. So just so you know, a couple things too. When I have a podcast, we are doing bookings. We record Fridays from 10 to 12. If it's third Fridays, we record on Tuesdays. We are looking for people that are specialists in their category. And we ask that you do have real estate properties, investments, so that way we have some other conversations to have too. We are looking also for somebody that's a rookie that's actively looking for their first investment and that maybe wants to pick Owen's brain or my brain and just have one of those podcasts where you ask us the questions. We're open to that too. So if you want to be on a podcast or know somebody who wants to be on a podcast and get some recognition that way, we're ranked in the top 2% of all podcasts in the world now. And that's out of 3-point-something million podcasts. We are now ranked 10th largest podcast of all podcasts in the Nebraska area and 13th in all of Midwest. So we're growing. And if you want to be on that, please let us know. If you've been on the podcast, can you raise your hand just so we know who you are? Yep, Nikki, Hal, who's over there in the back, Eccles. Yeah, I know there's a few other people. So if you want to be on or talk about that, please let us know. We really appreciate that. And give us a 5-star review. I'm going to say that every time. We have, I don't see Ram back there. who's back there in the corner to pull the business cards? Dave, is there any business cards in the book bin right there? Will you pretend you're Vanna White and pull me out a name? And then say there's 2 books to give away. There's a Rich Dad, Poor Dad book in there, and then there's a leadership book in there. So Vanna Dave Marriott is pulling the card. There's vigorous mixing going on, and they're going to announce the name and the business. Hey, look at that. Okay, so there's 2 books in here. Grab the book you want, and then there's one more. You get first choice. So you get Rich Dad, Poor Dad. Have you read that book right there, Rich Dad, Poor Dad? There we go. Okay, here's the next one. This is usually where Dennis plays special music, but he's not liking us today. Yeah. Mo Albers. Is she here? Oh, you gotta be here to win. I don't think so. That is some excitement right there. Yeah, I think the odds are in their favor. There's only like 4 or 5 books in there. 2 things before we wrap up here. Again, thank you to Dave with Midwest Title, helping us out with the books and also being our event sponsor tonight. Thank you to Set the Stage, and thank you for being our drink sponsor tonight. Give a round of applause for our sponsors. They really help us out with all of our events. Before we go, there is a mic up there. If you have a property to sell, something you want to shout out, this is the time to do it. They're really cracking down, just so you guys know, on especially Facebook groups that allow postings of properties. And I'm going to let you guys know in the next week or so, we're going to be announcing rules that you can't post any properties, no matter who you are on the Facebook group. They just shut down a group of 500,000 members in Houston, Texas, because the postings were illegal, and then it got reported to Facebook. Every posting that isn't done legally on our page, maybe it's a wholesale, maybe you don't put that you're a realtor, maybe you don't put that you own the property, I can get fined for up to $500, and I hold a real estate license, so I can lose my license for up to 6 months per time. So if you guys wonder why I'm such a stickler on that, because my name's on the group, I'm legally responsible for every posting on there. And so we're going to come up with some alternatives in January for you guys for those options, but we are going to disallow it. But if you do have something you want to sell, this is the time to get on the mic, because you can shout it out and it's all on you. But if you got a business you want to promote, something you want to sell, this is your last chance. Mike really wants to do it. Go.
So I've got a house at 1915 Lothrop. It's a big ass house. It's I haven't even finished cleaning it out, but it's move-in livable. It's like a 5-bed, 2-bath, no car. There's a 1-car garage in the back. 1915 Lothrop, Lothrop, and I do own it.
Cool.
Is that it?
And how much is it?
I don't know.
Well, I mean, we need a price.
I don't know, 190, 200, somewhere in there.
Okay, 190. We'll go with that number. Yeah, we like that number better.
Everybody should have said 200 and 190.
Yeah, you should have, but that's at 190. Maybe 180. Who knows? I've always wanted to be an auctioneer. Let's try it out. Anybody else want to shout out their business? Especially if you're a sponsor in the room and want to shout out your business, please do.
Not a sponsor. I should be. Ray Griggs Advanced Property Image in Omaha. I'm a 3D photographer. I can do an as-built drawing. I charge 7 cents a square foot. See me.
Awesome. Thank you. Anybody else? Last chance. Okay, guys, appreciate you guys. All of our events coming up, there's flyers on the outside table. Please grab one. And then there's flyers on the table. Take one, because otherwise it's going in the trash. Appreciate it. Please sign up for our REIA Mastery. If you have any questions, let me know. And I'd love to see you guys in the bar for the after events from drinks. Appreciate you guys. Have a good night.